Hi, I'm Chris Dibble with Jones Lang LaSalle, and here's something to think about. The environment that retailers are operating within proves challenging. New Zealand consumers have changed their spending behaviour and remain much more budget conscious since the economic recession. Core retail sales remain low, and New Zealanders' appetite for debt is at record lows. Government policy changes affecting inflation, such as the increase in GST to 15% and the eradication of depreciation deductions for buildings, will affect the sector. However, closer analysis on the trends emerging in the market points us towards some positive signals for the property retail sector over the next 12 months. Vacancy rate movements in Auckland and Wellington have been relatively in sync with the unemployment rate over the last 17 years. Currently, the Auckland and Wellington vacancy rates are both at just under 5%, while the unemployment rate reached a cycle peak of 7.1% in 4Q09 and now sits at 6.8%. Forecasts expect the unemployment rate will improve over the next 24 months. This means that an increase in occupier demand should start to flow through to the retail sector soon. There will also be a one-off lift in retail sales with the 2011 Rugby World Cup. Up to 85,000 extra visitors will come to New Zealand and are likely to inject around $535 million into the economy. This will be an important time for retailers to capture some of that deserved revenue. The increase in retailer turnover and occupier demand will place extra pressure on rents to increase. So what does this mean for people in retail? For the retailer, the increase in inflation due to the introduction of ETS and the rise in ACC levies and GST will impact retailers with a CPI fixed rent review. Over the next 12 months, there will be an increasing appetite from your landlord to start increasing your rents. We expect rental growth in the vicinity of 1 to 3% over the next 12 months. For landlords, it's probably been a long wait, and the ability to increase rents will be a welcomed opportunity. However, bear in mind that some of your occupiers may not be able to cope, and we stress that open dialogue will be important as we start to move through the next phase of the cycle. For investors, rental growth on the horizon should start to flow through and help stabilise values. While the impact of government policy changes has yet to be fully translated into asset prices, your investment decisions need to incorporate the small window of opportunity that remains in the current climate. It will be a good time to be proactive in the market and take advantage of the current situation. The window will only be ajar for a short period of time. Just something to think about.